The summer heat isn't going anywhere, and neither are we. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we don't have a lot of significant new content that's coming out recently. It seems that the AICPA and the FASB are taking a little bit of a hiatus, and that usually happens in the summer. But I've noticed over the years, actually, that actually since COVID, the FASB hasn't really come out with a lot of heavy new pronouncements, but shh, because they hit us with, leases and RevRec, and then the one I'm going to talk about next. But they did come out with an exposure draft, and it's a proposed ASU on purchased financial instruments. What the heck is that? Okay. So when you purchase a company, you acquire a company, there's certain financial instruments, and they want the companies that are purchasing to consider if there are distressed debt or there's actually issues as it relates to those financial instruments. Now I'm going to read you what kind of the summary of it is under current GAAP, if a purchased financial instruments has experienced a more than insignificant deterioration in credit quality since origination, it is accounted for under PCD or the gross-up approach with no credit loss recorded on acquisition. I find that very interesting because you would have never thought that that's how it would have been. Well, guess what they want to do? They want to change it so that if there is a more than insignificant deterioration in credit quality, that you have to account for it as part of the acquisition. So it sounds very logical, but this all ties in with CECL. Now, if you remember, Frank and I have talked about CECL. We've mentioned CECL, current expected credit losses, if you don't know what CECL is. We've discussed CECL many times. I've discussed it on many of the episodes. The important thing is CECL is effective now. But why am I focusing this? Why am I constantly talking about this? Because this is such a big issue. I've noticed leases were effective last year. We're still trying to get companies, as public accountants, we're still trying to get companies to effectively adopt it the way they are supposed to for calendar year 22. And people really fell asleep at the wheel. This is another big one that it may not have significant impact on your financial reporting, but has to be documented properly. And if you wait until the audit's going on, it's going to hold everything up. And we're seeing that this wave that has just keeps crashing on the shore of year-end reporting that's having a difficulty to get out because of many things, but part of it is because of the leases. We don't want to have this happening with CECL also, but that's just my little editorial comment. Just remember, CECL requires companies to estimate the expected credit losses of an instrument over its lifetime using the historical information, current conditions, and reasonable and supportable forecasts that affect the collectability of the reported amount. Assets are measured on a pooled basis when similar risk characteristics exist. What am I talking about? You think that this doesn't affect you? You think, oh, credit losses, that relates to banks and lenders. Yes, it does. It relates a lot to banks and lenders. But if you have accounts receivable or if you have grants receivable, you have to consider stuff like this. And what you can't do is just say, my allowance for doubtful accounts and my accounts receivable has been $10,000 for the past year. That sounds like a good number. That doesn't work anymore. Or, well, my bad debts have been $40,000 over the past 3 years. That just alone doesn't work anymore. You're going to have to tranche out or bucketize your receivables with different characteristics and measure them and determine what their collectability is on a rolling forecasted basis. So this is a very deep topic. Frank and I have talked about this a lot, and I know that one of the chapters has asked if a seminar could be put on for this. Find the seminar. Pasake's looking to do it. Find the seminar. I recommend you take one specifically on this topic, not just a 10-minute podcast to cover it. That's not enough. Although I'm good, but that's not enough. As it relates to this guidance, the SEC has actually asked for a delay in pushing this out because it's just getting so deep, and the content of the people absorbing what's required, they just think that there's more time is needed. Now, if you saw a Wall Street Journal article recently, they're saying that some of the companies are having issues with reporting because of the lack of quality staff to be able to focus on these issues. And I'm happy that if you take the SEC's comment of saying, let's delay this a little bit, and you look at the article, it's like, okay, let's take a pause on some of this and let's digest and get people to really absorb what's going on, rather than have material weaknesses being reported. Okay, as it relates to reportable items, proposed adjustments. I know it's kind of a little jump from reportable items, but proposed adjustments. Theoretically, as an auditor, all adjustments are proposed, and if the client accepts them or doesn't accept them, you have summary of unadjusted differences. Those are the adjustments that were not booked or accepted by the client and being recorded as part of the financial statements. What I see a lot is when people analyze their past adjustments, summary of past adjustments, summary of unadjusted differences, whatever you want to call it, people don't take into consideration the proper aspects. There's generally two methods to consider: the rollover method and the iron curtain method. The rollover method assesses the income statement errors based on the amount by which the income statement for the period is misstated. Okay, that's just the amount. That's just what's happening this year. The iron curtain method assesses income statement errors based on the amount of which the income statement would have been misstated if the accumulated amount of the errors that remain in the balance sheet at the end of the period. So what are we saying here? The rollover method is pretty simple. What's the effect for the item this year that's not being booked? The iron curtain says, what's the accumulative effect? So if you have not booked deferred rent, and let's say your deferred rent adjustment is $10,000 a year, the rollover method is $10,000 this year. If you haven't booked it for 4 years, the iron curtain says that your liability is misstated by $40,000. The P&L effect for the current year rollover is only $10,000. Your equity effect would be the total of $40,000, and the liability is $40,000. So the iron curtain is the full amount that should be in there. What I see a lot is many people forget to consider the prior year's past adjustments. So if you passed on something last year, there's a good chance that that has an effect that it should have rolled into this. It will have rolled into this year. So if you have revenue that you said that you didn't record last year, you didn't book $50,000 of revenue, your income statement is misstated, is understated by $50,000, your accounts receivable is understated by $50,000. You now go into this year, your revenue is overstated by that $50,000. So you have to assess the materiality of last year, but also assess the materiality of it, effect on it this year. Now, remember, the past adjustments from prior year don't affect the balance sheet for this year. Theoretically, they wouldn't unless it's a cumulative effect. That's the iron curtain aspect. But generally, they don't affect it for rollover type of items. Keep that in mind. Materiality, I mentioned. Materiality is important individually and in the aggregate. If you have a journal entry, a past journal entry that's $1 million this way and another one that's $1 million this way, individually they could be material. In the aggregate, they might be immaterial, but you have to consider it both individually and in the aggregate. There are many third-party practice aids out there. Use them and use them properly. Most of them have it where it goes assets, liabilities, equity, income statement, the tax effect, and then you go to the bottom and it has the amount that relates to the prior year, and it gets backed out. And then a lot of times on the bottom, people miss, but it has the financial statement captions for the assets, the liabilities, equity, blah, 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 blah. And you're supposed to compare the amount of the adjustments, the cumulative amount of the adjustments, to the financial statement caption and the materiality of it. Keep that in mind, and then you're supposed to come up to a conclusion on the bottom. Make sure that's all done. Why do I bring this up? You hear me say it all the time. I see this during peer reviews and reviewing work papers, type of thing that's missed a lot. Okay, one more item. For our RMA friends, Registered Municipal Accountants that is, the GASB has implemented guidance number 2023-1. It's a Q&A to address applying GASB standards on leases, subscription-based information technology arrangements, and accounting changes. So it's a lot of good information. Now, I don't do any municipal work. Our firm does municipal work, but during my internship, I did municipal work. But there are a lot of accountants out there, RMAs, or other people that do municipal work. I recommend that, and I'm not just talking public, there are people that are in the government realm. You should look into this. It's good guidance. I don't do the municipal work, and I still looked over it because I thought it was interesting because it talks about leases, I guess, again, subscription-based information technology. Those two I really found interesting, and then accounting changes. Those are the big topics for today. In closing, I want to let you know about a few upcoming NJCPA events. Renee Rampula will be presenting on the new quality management standards during a free Membership Plus webinar on August 11th. And the Atlantic City CPE cluster will be taking place on August 21st to the 23rd at Harrah's. Register at njcpa.org/events. Also, the NJCPA chapters have started selling their CPE passes. Learn more at njcpa.org/bundles. And lastly, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups.